Today's webinar is brought to you by the Rising Tide Mastermind. The Rising Tide Mastermind is a group of individuals that get together regularly, not just to help with each other's issues, but to help us all get further faster in all areas of life. Whether you join the Rising Tide Mastermind or another group, now more than ever, everybody needs a group of trusted advisors. The Rising Tide Mastermind is putting on this proactive webinar series so we can focus on the things we can do and not worry about the things we can't do. Our presenter today is Mike Iverson of Trillum Financial Services. Mike is the numbers coach, and Mike provides CFO services for many companies, including ours. Today, we're going to be talking about the CARES Act and try to answer some of your questions. Welcome, Mike.
Oh, thank you, Trace. Glad to be here.
Absolutely.
Thanks
Mike, so many of us, me included, I mean, there's so much going on with the CARES Act. It seems like almost every day we're learning more about what was passed. So I know the information you're going to share, it's only as good as the information you have up until this moment of time. But that being said, you know so much more than people like myself who need to do something with this information. But because of information overload, some of us don't know what we need to do. So I'm hoping we can help a lot of people today.
Well, I hope so too, Trace. You're absolutely right. It has been changing quite a bit. Even just recently, there was an update brought out by the IRS with some of the CARES Act provisions. So you're absolutely right. We're all going through this together, trying to walk our way through it and navigate. But we'll get through it. That's for sure. But what I want to do is with the CARES Act, what they basically did for small businesses is they provided basically 4 programs. If you can see up on our screen here, we've got the Paycheck Protection Program, or as people have been calling it, the PPP loan. You've got the Emergency Economic Injury Disaster Loans, or the acronym EIDL, and there's a grant that goes with that, and we'll talk about that. There's also a program for delaying employer payroll tax, which is the Social Security tax at 6.2%. And then they also included an employee retention credit, which is a credit that employers can get for compensation and health benefits related to employees that they keep on the payroll. So what we're going to do, Trace, I thought, is we'll dig into each one of these a little bit. Mostly we'll probably focus on the payroll protection, PPP, and the EIDL, which seem to be the big areas of interest these days. Just from a real high level, the Payroll Protection Loan Program is one that we've heard most folks talk about just recently, just got enacted as part of the CARES Act. A lot of folks have been applying for it. You probably heard in the news with a number of the applications being by the thousands, if not hundreds of thousands. And the idea with that program is essentially if you look at between that and the EIDL, is it's more of an immediate program. It's a program that doesn't require any collateral, doesn't require a personal guarantee, and you're actually getting the loan directly from a bank. And the bank is typically one that is a SBA approved lender. And the SBA actually expanded their network of lenders as a part of the CARES Act. Some institutions might not have been SBA lenders prior to the CARES Act or leading up to it, but some now have become SBA lenders. So you're getting your loan directly from a bank. And the bank, you would go through them and you would apply through them. The EIDL loan/grant is actually going directly through an underwriting process through the SBA directly, which means the federal government is actually funding it directly through the SBA. Now, what the CARES Act did do for this EIDL is they did waive collateral requirements, and but it still requires a personal guarantee and some underwriting. Now, the EIDL has actually been around. This is a loan program that has been in effect for quite some time and is related to natural disasters that we all typically think of. Hurricanes, earthquakes, fires, natural disaster fires. So that in areas where a governor has come in and declared it a natural disaster area, which at that point then FEMA and other agencies are coming in to help in the recovery of it, these small businesses can go to the SBA and get favorable loans to get back into business. So this has been around for many, many years, but under the CARES Act, there were certain things that they did to help broaden the scope so that more businesses could fall under this act and be able to access these funds. As I know of today, I believe all 50 states, if I'm not mistaken, have declared a natural disaster with COVID. Therefore, all businesses, small businesses that would be eligible would be able to apply for this type of loan. So what I thought we'd do, if you want, is we'll step into each one of these, but mainly the first two will go into more depth and learn a little bit more about each program. Who's eligible? What's the way to do it? How to apply, etc. Does that make sense?
I think that'd be a great way to do it, Mike.
Okay. All right. So let's go into the Paycheck Protection Program, or PPP.
That is hard to say.
I know it is. It can be a mouthful because after saying it for so many times for the last couple of weeks, if not longer, it gets a little confusing sometimes for me. But just PPP. So all businesses that have employees of 500 or less are eligible. Now, the interesting thing about that is, what does that mean? 500 employees. Is that 500 full-time equivalent employees? Or is that 500 employees as a head count? And actually, the CARES Act was not very specific with that. It was, some people were like, well, I think it's head count. Some people were like, I don't know. So what I've experienced with clients is we've used FTEs when we felt like we had the sophistication to do that. What do I mean by FTE, full-time equivalent? So let's think about someone who is full-time working 40 hours, or somebody who is part-time, let's say they work 20 hours. So they're like a half of an employee. So if I've got a head count of 10, of which 8 work 40 hours, but 2 people work 20 hours, then what I have is an FTE of 9, because those 2 part-time employees make up 1. Therefore, I have 9 FTEs. So some have been applying using that FTE concept. Others have applied just saying, I've got 100 employees, that's my head count, regardless of whether they're part-time or full-time. Now, the interesting thing about this is in the Act, when we get to the point of we talk about forgiveness, it talks about FTEs. So that's why some people have leaned to using FTEs at the outset, because the forgiveness is going to be based on a calculation related to FTEs. So that's one interesting thing that hasn't been clarified, but the best thing is when you're applying to your bank is go through that process with them, because now they would have had some experience in saying, or gotten clarification directly from the SBA of what's the best approach. Also, you needed to be, applicants needed to be in operation on or before February 15th of this year, of 2020, in order to apply for these loans. Now, the SBA considers a small business. Their qualifications typically are that their net worth is $50 million or less. And in the last couple of fiscal years, their net income is $5 million or less. So that's how they qualify as a small business. Now, that doesn't mean that others that are outside that might not be eligible, but what you'd have to do is really check with your bank to make sure. but that is one qualification that they do have in the regs, the SBA specifically. So now who's ineligible? Well, and that's sometimes a question, but if you're in an illegal activity, and that's actually an illegal activity under federal law, state law, or local. So what that to me conjures up is for those who are in the recreational marijuana, that brings up a very interesting question from a federal versus a state perspective. That I don't know. So I was thinking about that the other day with some colleagues, how does that play out? And then household employees are employers, meaning if you have a nanny or a housekeeper that you're employing, those are not eligible for these loans. Okay. In general, the Paycheck Protection Program will loan up to $10 million. That's the limit. And the loan amounts are basically 2.5 times your annual monthly average payroll cost. And we'll dig into what payroll cost, what that means, what's that definition. But again, it's 2.5 times your average monthly payroll cost. Most of my clients have been using fiscal year 2019 data because it's done, it's been filed, and it's a easy benchmark for folks to use. However, the Act does allow you to use a trailing 12 payroll. So if you're applying now in April, you could use April of last year through March of this year as a part of your application process. As I mentioned before, these loans, the PPP program, is actually funded through a bank. So you're applying with your local bank. And typically what mostly has been happening is banks are first dealing with their own clients initially, and then some are taking applications for those who are not clients. So the loan is 100% guaranteed by the SBA, and that's part of the reason that some of the banks have been able to quickly turn on a dime with this, because typically a loan program that banks participate in, like the 7A program, are backed by the SBA, but only up to a certain percentage, like 75%. So the balance of that loan is actually being made by the bank itself. And so they do more rigorous underwriting with that. Here, the underwriting is really, there isn't any real underwriting other than there is some certifications that we'll talk about.
Mike, I've heard that smaller banks are a little bit faster than the larger banks. Can you comment on that?
I can a little bit, but that is probably a little bit truer. I've had some clients who have applied at larger banks like Wells Fargo or a few others. And yes, because they have been so inundated with, they have so many more small business clients than some of the smaller local banks do. Plus, some of those bigger banks are also dealing with some very large syndicated loans with multi-billion-dollar companies who are also trying to juggle, because there are some CARES Act programs in there as well for larger companies with employees that are in the thousands. And so the banks are also trying to deal with that as well. And there's only a certain amount of liquidity available from a bank to support all these loans. So I wouldn't be surprised if it was going to take longer for a PPP loan for a small business with a larger financial institution than it would for a smaller financial institution. What was interesting, I heard yesterday, this is highly unusual, is that banks, typically banks have a reserve requirement that says they have to keep so much money in reserve in case loans go bad, so that they can cover those loans and be able to not take a hit to their own financial bottom line, and then also find themselves in trouble, as happened in 2008, 2009. But at this point, the requirements have been reduced to almost, from what I understood, almost to zero. which is highly unusual, but largely because they're trying to get this liquidity out into the marketplace to help support businesses of all sizes while there is this mandatory distancing and shutdown process in place. Unprecedented. This was obviously not a case in 08, 09, but here it's very different. So that is an unusual thing that we do have today. So also with these PPP loans, there is no payment required for the first 6 months. Interest does accrue. So when you get approved for the loan is, and the funds are dispersed, you have 6 months before you'd have to make your first payment. But interest does accrue on that. So what folks have also asked about is documentation. What typically do you have to submit in order to apply and get approved? So typically what they've been asking for is annual payroll tax returns, which is a 940, quarterly tax returns, which is a form 941. So if you're filing using 2019 data, you'd have your 2019 940, and then you'd have quarterlies for quarter 1, 2, and 3, and 4 for 2019. Now, I don't know if any of your audience is independent contractors, but if they are allowed to apply also for a PPP loan. And the documentation that they would submit would be, for instance, a form 1099, which they would get from their various customers to document how much compensation they received. And that would be a part of the application that they would apply for as an independent contractor. If you're a sole proprietor, which means you're actually filing your business results, your income and expenses and profit on a Schedule C on your 1040 tax return, personal tax return, then they would submit that return with that schedule showing the amount of income that they had made over the course of, say, 2019. Also, as one of the stipulations in the calculation for getting your loan, you're expected to remove those folks who made over $100,000 a year. They cap the limit of compensation available to calculate your loan at $100,000. So, for example, if an employee makes $250,000, then they're capped at 100, so you would have to back out 150 of their payroll in order to then calculate what your loan amount would be at that 2.5 times. So you'd want to have W-2s available for all of those who made over $100,000 to document this is the employees who made over that, and it's filed with the IRS. Therefore, you have proof that you've made that removal. What else? So we know that compensation is a part of payroll costs. So what else goes into payroll costs that the CARES Act has allowed is medical premiums for health insurance, retirement benefit payments, meaning typically for us, 401k matching programs, or maybe 401k profit sharing programs. So if the employer has matched for employees during the year, or if an employer has contributed a profit sharing amount from its profits into the 401k for its employees, those expenses are eligible for the calculation. And then also what's eligible is any state, local, or city taxes paid by the employer on compensation paid to employees. Here in Georgia, or in some states, I think in New York and California, there are some localities that do tax compensation on employees for the employer. For some, it's going to be state unemployment tax, for example, is going to be typical for most locales. So those are what are eligible for the payroll cost calculation. So the definition again is gross compensation, medical insurance premiums, retirement benefits, 401k match, profit share, for example, and then any employer compensation tax paid from a state a local or city level. Those are all able to be averaged on a monthly basis and part of your calculation of the 2.5 times. And I'll run through a calculation here as well. So going back then from there, we were talking about, well, medical premiums. Well, how do I document that? Well, what you'd want to do, what we did with a client, for example, was we went in and we were able to pull the premium statements for all 12 months in 2019, showed the total amount, and also had the bank statement where we showed either the check was clearing or it was an ACH, and we could show that we paid it as well. And then we took that 12 months and averaged it. So totaled it up, divided by 12. Then we went in for our retirement benefits, and we looked at, did we do a matching? And one of my clients, for instance, the way they match is they do what's called a safe harbor, 3% safe harbor rule, which means that they're contributing essentially 3% of the total compensation of these non-highly comped individuals in their plan. So they were making that contribution every quarter. Then they also made an annual contribution for a profit sharing piece. So we added up all those numbers, divided by 12, and that was what we put in as a calculation. And we documented it by providing the documentation for showing how that calculation was done with the total amount, and also a bank statement showing that amount getting paid. Then we did for the state, local, and city tax. In this case, the client I had a little bit of state unemployment employer tax paid. We received that information from our payroll tax provider, or payroll provider, I should say. They outsourced their payroll. They provided us a report of the monthly amounts, and then we divided that by 12, and we were able to show them that report, and we used that to calculate. So we added all those up, and then we came out with what our loan amount would be. And that way we could know when we were filling out the application, because applications actually are almost by bank how they wanted to set it up. Some have a certain way of doing it, others had another way of doing it, but they all came to the same number. It's just a matter of how you input some of the data. So that's the documentation that would be required. Also, if you have owners, if you have multiple owners in a business, any owner in a business that has 20% or more will have to sign the application and certify it and provide a driver's license or a government issued ID as a part of that application. So if I've got 3 owners and there are a third, then all 3 owners have to sign that application, certify it, and provide ID as well. So one of the things that came out later in the act was some clarification. There was a little confusion over about independent contractors and did they count as employees? Sometimes, for instance, you might have somebody who left your employment at the beginning of the year of, say, 2019, and they became an independent contractor for you for the rest of the year. Well, that person, that independent contractor, can go and get their own PPP loan. Therefore, they cannot be considered as headcount in your calculation and as a part of the payroll cost, because they're getting it somewhere else. They're able to get it on their own. Otherwise, we're double dipping. You know, if a business includes it and then that other independent contractor goes out and gets their own loan, now we've double dipped. So they came out late, about a week after so the CARES Act was passed, and issued that clarification. One of the things that's a little interesting with the documentation and eligibility with this is, you know, LLCs can be formed in a tax manner in various ways. It can be either a partnership or it can be taxed as a corporation. So one of the things I ran into with a client, for example, was it was an LLC taxed as a partnership. which means we had a couple of partners. And those partners were actually paid as W-2, but only part of their compensation was W-2. And technically, they really are not a W-2 employee. All right. So that's the one thing in the regs and in the CARES Act that is not clearly identified. How does a partner apply? Do they apply as a part of the payroll and a part of the staff, or do they have to apply as an independent contractor? What we did with one of our clients was the partners were actually paid a draw and on a W-2. So their compensation showed up on a W-2. It showed what was not taxable and what was taxable. And so we were able to then say, okay, well, we're able to submit a W-2. It's filed with the IRS. We have that documentation. So we can include them in all the payroll. And we just simply would back out any income in excess of $100,000. And that's what we did. From what I know, although this is still in process because loans are still getting approved, they have, as far as I know, the bank said that's fine. We'll accept it that way. So that's what I know today. That could change. They might come back and say, no, we're going to do it differently. But as far as I know, that worked for them. So if you've got folks in the audience where some of the owners, they don't take a salary, they're actually just taking draws, or they're taking, it doesn't show up on a W-2, then for that compensation, they might have to apply independently versus applying for all their other employees. Just a weird little quirk that unfortunately is open to interpretation. Use of funds. So for this PPP program, once you get your loan, you get approved, you can use the funds for payroll costs like the benefits, medical benefits, gross compensation, commissions and tips and so on can go in there. Rent. So if you are leasing a building, you can pay your rent, your utilities, like water, AC, telephone. And you can also have it pay for mortgage interest or interest on existing debt. Just keep in mind that the interest portion on the debt cannot, it will likely not be forgiven. So those are the usages of the funds. Now, typically what's going to happen, they call this the covered period. And that covered period is typically going to be 8 weeks. So it's from the date of the loan through 8 weeks. And that's when you get the chance to use those funds. Okay. Let me go to also, before we get into maybe loan forgiveness, which is, I know, a part that folks are probably thinking about, how does that work? So let's do the terms and certifications. The term of this type of loan for any part that is not forgiven, it's a 2-year loan at about an interest rate of 1%. And that's what they set. Now, what they did say in the regs from the SBA, it did indicate that the administrator, which is the financial institution, can have apparently some leeway to extend that if it needs to be, I guess. They did say it could go up to 10 years, but the way it's been written is they felt like when they were putting this together, Congress and so on said that they felt 2 years was a good enough period for payback for any amount that's not forgiven. The other thing, what do they have to certify for the loan was, one, they were in operation prior to February 15th of 2020, that the current uncertainty in the situation, the economic uncertainty, has made this loan necessary for their operations to keep people employed. And then the funds will be used to retain these employees on payroll, and the usages as well, the mortgage lease, the mortgage interest and lease payments and so on, that they document and verify that they have put in the correct amount of full-time employees or headcount. So the forgiveness piece of it, I know, is a big part of the PPP program, and was, you know, touted in the media, but also throughout, you know, the lending institutions. So here's essentially what they're saying is you need to spend at least 75% of those loan funds on payroll costs, or supporting those folks with their compensation. So that would be gross compensation as well as medical insurance payments. 25% they're expecting, because of this being such a popular oversubscribed program, that 25% of those costs can go towards the rent, utilities, mortgage interest, etc. So non-payroll cost items. And that way, if you fall within those guidelines, the likelihood is, you know, you would get the loan forgiven. However, the forgiveness does have to come where you are applying for it. You have to apply to the bank for that loan forgiveness after that 8-week period of using those funds. And of course, any of those funds that is not forgiven then turns into that 2-year loan with an interest rate of 1%. There is a calculation. I'm not going to probably go through it because it's very arcane, but there is some good documentation that certainly we can send out to your audience that would show essentially examples of how that would get done. The key is that you're keeping your employees on staff employed through this 8-week period. If you do let some go during that 8-week period and your headcount gets reduced and your payroll cost does get reduced, then that amount will essentially go against you in terms of a portion that wouldn't be forgiven. Okay. And that forgiveness, the way I understand it today, is it will not be a taxable event. It's not like in normal circumstances when you have a debt to a third party. When that is forgiven, the IRS says, well, that's income to you, therefore it's going to be taxable because you no longer have to pay that debt. In this case, they, from what I understand, have written it such that that will not be. You will not have to report that for taxable income purposes. I think the key will be is how do you make sure you document that you used these funds in the appropriate way so that you do get that loan forgiveness. So what about some strategies behind that? And I'll give you some examples that we've been recommending for clients. So one would be when those funds come in, if it were me, I would have a separate bank account for just the PPP funds. And it goes into that separate bank account. And then when I start to use that money for payroll, there's a couple of ways maybe to do it. If you've already got a payroll bank account set up where maybe your payroll provider comes in and pulls the money out from that account, what you might do is one of two things. One, you could just tell your payroll provider, for the time being, switch from taking it out of this account to over to this account. And then we will stop, after the 8-week period, we will stop taking funds out of there because maybe by that time, of course, the funds will be depleted at that point. Or as you are doing your payroll, if they still are going to come out of that payroll account, then you move the exact amount of money for that payroll over to your payroll checking account. And that way, then it's pulled out by the provider or you've run those checks yourself out of that account, but you've shown exactly that exact amount going over to that bank account from the PPP bank account. For the other expenses, like rent or mortgage interest, or retirement matching benefits, for example, again, you can do it where you transfer those funds to your checking account that you're making those disbursements. What I would recommend if you're doing that is that you run those expenses separately from all the other check runs that you do. So I would do a separate check run just for rent and maybe the retirement benefits or the mortgage interest. Try to do those as either one check run or each one as a separate check run, but not with anything that you're dealing with, office supplies or reimbursements to employees or something. Leave that completely separate check runs. That's one way to do it. Another way to do it is to just simply do either online banking ACHs out of that PP account for those other expenses alone, and just simply disperse them from there. And that would be a way to completely isolate it. It comes out of that account, and the only transactions that are coming out of that account are the ones that are authorized usages for the PPP program. So those are some ideas in terms of how do we isolate those so that way we're tracking that data. Because once that data kind of gets over into your financials, it's going to be much more difficult to say, well, here's my payroll for the last 2 months, and that's what I use these funds for. But that'll be a little bit more difficult to tie the two together.
Mike, is it possible to do the same thing without a bank account, but to just have a separate accounting account in your chart of accounts and bring it over within that?
You can. You can do that. It's certainly a way to do it. I think if you're doing that, again, you're doing a bank reconciliation, bank statements. I think what the banks are still going to look at, potentially, I don't know, is to say, well, show me the ins and outs. I want to see it in your accounting records, but I also want to see it in something that either we controlled, so that way we can see how you pull those funds in and out. And you can clearly show in your records and then maybe in your bank statement too, how that flow of money went. So yes, you can do that.
It sounds like you recommend having a separate account because that way you have an additional trail.
Absolutely. Additional audit trail. Because if I'm doing this loan and I'm really doing it because I don't want to have to, if it's a 6-figure plus loan that has to be paid back in 2 years, even at 1%, it's a great interest rate, but you still got to pay it all back then if none of it's forgiven. And if that's $200,000, $300,000 and you're still getting your business back up to where it should be even a year from now, that can be a strain on your operations. So I'm just telling folks, be real careful if you're going to not set up a separate account for it, to definitely make sure you have your I's dotted and your T's crossed really, really well in your accounting records if you're going to still have it come into one checking account that you use for everything. So that's the PPP loan program in a lot of depth, I know. I don't know, there's other questions that have come from your audience over the last couple of weeks that you have further questions on that particular program.
I think you've answered all the questions that I've accumulated from people that I spoke with. I know you're going to talk about the economic injury disaster loan. There's some questions around that. A question that I have that came into mind is as we're paying payroll through that new account we set up, we're now approaching that 2.5 months, and now our balances are below what the bank requires us to keep in without fees getting charged. How is all of that going to be dealt with?
That's a great question. That I don't know, other than when you are setting this up with your bank. Mike's inkling is that they will waive that. that if it gets to the point where your balance in that account gets down to, a few $1,000s left after your 8-week period, then and then you use those funds for, again, just to wrap up with the right usages, essentially you're going to close that account out. After that, for a number of months, I don't see where a bank would have in their best interest, although this isn't the case, but in their best interest to go, well, we're going to charge you fees for having a dormant account or for it to go below a certain threshold. Don't know that for a fact.
Sure.
But that's a great question to ask your banker as you're getting this set up.
So I'm assuming the process, when you fill out the form, it's asking you, what is your account that you want that in. So it's going to go into your general operating account, most likely.
Correct.
Then we need to have a call with our banker, let them know that we want an additional paper trail. For that reason, we're setting up another account for this purpose. And then we need to move the money over from our general operating account to this new account. That's pretty much how that would go?
Yep.
Okay.
Exactly. That's how I've seen folks do it. So that way they do get the funds in, but then the bank, you put them on notice after you you've applied and you've gotten approved. And you're right, you document what account it goes into. It'll go into that main to do exactly that and have that all set up. Yeah.
And Mike, in 8 weeks, when we can apply for forgiveness, is that something that the banks are going to initiate? Are they going to send us a form? Do we have to now have that conversation with them and tell them you need to send us the form? What do you anticipate with that?
My anticipation is it'll be on you, the borrower, to turn around and go, okay, my 8 weeks. So I got the loan on May 1st and now my clock starts ticking. So on July 1st, thereafter, I'm going to go ahead and apply for my forgiveness. And what I think, and that's potentially why they wrote in the delay in terms of any payments for 6 months. So that way you have time to document, go back and see how much of that loan is going to be forgiven. And then they would probably go back and say, okay, he had a $300,000 loan to us. He used it for the appropriate amounts, but we didn't get all that done and solidified until, let's say, August 31st. In the meantime, we've got interest accruing, but the bank will go back and have to go, okay, well, we've forgiven 200,000 of that. 100,000 of it is not. So therefore, it's going to be accruing interest on 100,000 from July 1st through the 31st. But there has to be some time in order to document that with the bank. And the borrower will, from what I understand, will have to go to the bank and ask for, I want forgiveness on my loan. Otherwise, if they don't, then it does trip into that 2-year loan at 1% interest with an amortization schedule from there.
So to make sure I have the timeline right, we've got 8 weeks to start paying the charges that you mentioned were acceptable. After that 8 weeks, we have an additional 4 months to file that forgiveness paperwork?
Yes, if I understand correctly. Now, there hasn't been any guidelines that said you have a specific deadline to ask for forgiveness. There's nothing in the CARES Act that says if you don't file by this date, you're not going to get it forgiven. So there isn't anything in particular. I would just be on top of it. And if it were me, I would say I'd rather do it sooner rather than later. Mm-hmm. And I think there'll be some guidance that'll still come out that will clarify that for us. But there is no hard and fast on this that I'm aware of. And there's no banker that has said to me so far, well, yeah, after 8 weeks, if you don't apply within 30 days, you don't get forgiveness. I don't see that at this point. So I hate to say it, but stay tuned.
Right.
But
that's how all this is playing out. We're learning more and more every day.
Correct. Right. Exactly.
Well, Mike, I think we all know a lot more about the PPP from your explanation. So I appreciate that. Can we move over to the economic injury disaster loan?
Yeah. So I'll bring back up that here. So the second one on the list is that economic injury disaster loan, emergency loan. And as I mentioned earlier, these are loans that have been around for small businesses related to disasters. And COVID-19 has been declared, as far as I know, all 50 states, a disaster by the governors that allows businesses to apply for this loan. There is underwriting, but they have waived collateral requirements. My understanding is there's still personal guarantee. But again, this loan is one that's going directly to the SBA. So you apply for it on the SBA's website for this loan. And then it's funded directly by the SBA to you. So let's jump into that. All right. Get a few of my notes here. So who's eligible? Essentially, as I mentioned earlier, most small businesses are eligible because most, as far as I know, all governors have said we're in a state of disaster. So typically what happens, you have to be physically located in the county that has had the disaster, which in this case, our audience would be located in the county that they're in where the disaster was declared. They have fewer than 500 employees. They do not have to be in business for this particular disaster. Typically it was they had to be in business for a year, but in this case they don't. They did waive that in the CARES Act. So you don't have to be in business for over a year. The ability to repay is there. It does have, i.e. some underwriting that they do require. However, the SBA has indicated that as you apply for this, some of the application can be strictly based on a credit score, for example, or some alternative method that the SBA decides that they're willing to underwrite the loan in. In other words, the SBA has given themselves a lot of flexibility, is the intent. I think the intent behind this is not as more structured underwriting that folks have maybe experienced or learned or heard about under the 7A loan program, for example, with the SBA. And that's at its discretion and how it underwrites. So the eligibility is same idea as the PPP loan. You can't be involved in an illegal activity from either a state, federal, or local law perspective. The one thing that is in this program is if a company currently has an SBA loan and it is delinquent, then they are not eligible. Now that, I don't know for a fact whether or not there's any sort of leeway at this juncture with that, but that is in the regs saying that if you are delinquent. And what does delinquent mean? Really, in the definition by the SBA is you missed a payment by a day.
Oh, wow.
So if you had a loan payment due on the 1st, but you didn't pay it, and it's now the 2nd or 3rd, you're delinquent in the eyes of the SBA. These are truly loans that are, again, funded by the SBA. There is no forgiveness provision in this, except when you do apply as a part of the CARES Act, the application, you can get, as a part of the application, a $10,000 grant. Now that grant is provided to the applicant regardless of whether they are approved or not. So if you apply and you don't get approved, you'll still get $10,000 from the SBA. As a grant, my understanding is, unless this changes, is that that grant is not a taxable event because it is a grant. It is something that is forgiven and you will not have to repay that. So that is something that essentially what they were talking about, it's like an advance against your loan effectively. But they also didn't want to discourage people from applying and therefore that's why they put, I think, the carrot out there a $10,000 grant, because even if you didn't pass through underwriting, then at least you got $10,000 to help during this time.
Mike, are there any stipulations on what that $10,000 can be used for?
I did not see stipulations for it. I did not, other than, no, I did not. I did not see any stipulations per se in the regs. These loans, the terms are typically, the maximum amount of these loans has been up to $2 million. I have not heard if they've expanded that beyond $2 million at this point. But the term on these loans is 30 years. It's not 2 years. So the PPP loan, if whatever part's not forgiven is 2 years, this happens to be 30. There are no payments on the loan for the first 12 months. And the interest rate on these under the COVID-19 disaster, the way they stated it in the SBA regs, was 3.75%. Okay. Typically, the rate varies based on disaster and the timing in the market. So it can range from low as 3% and as high as 7%. In this case, they locked it in, it looks like, at 3.75%. The loans under $25,000 don't require collateral, but as I said, they did waive collateral requirements under the CARES Act. So I think as you're working through this with your banker, I'm not sure if you're getting a $2 million loan, let's say, for the first time under the CARES Act through the EIDL, whether or not that requires collateral. That I don't know for a fact. I do know under normal circumstances, they said that anything under $25,000 loan required no collateral. But in this case, they have waived this collateral. Still a personal guarantee, but I'm not sure if there's a threshold for that collateral. Again, you're going direct to the SBA, and so that is, disasterloan.sba.gov, and that's where you will apply. There's no cost to it, and there's no obligation to take the loan, even if you're approved. So my understanding is you get approved, and then you decide, I'm not going to take it. And then my understanding, too, is that you still get your grant because you applied. All right, so the documentation is, since there is a personal guarantee, or if there is any collateral, then you need to supply documentation for that. A personal guarantee would require a personal financial statement. So the assets that you own personally and the liabilities that you have personally would be a part of that. They have two forms, the Form 5 or Form 5C. I didn't investigate the specific differences, but those are the forms that you would apply for the loan. There's also a schedule of liabilities as your business. What liabilities does your business currently have? So there's a form that you would fill out for that. And their personal financial statement form, which is Form 413, is what you'd also fill out. So that means you'd want to go to your personal statements and, whether it's investments that you have and assets like your home and so on, to go on your personal financial statement. They require that you provide them with a request for a transcript of your tax returns. So that's a Form 4506T. So that's really giving the SBA the opportunity to go to the IRS and say, give me some of their tax information. Granted, you will also give them your tax return information, but they also want to corroborate that they're the same. You're not giving them a different tax return versus what the IRS has. The usage for this loan, you can do this loan in conjunction with PPP, but the funds cannot be used for the same purposes. Typically, this loan is a disaster loan used by companies for working capital purposes. And what do I mean by working capital? Meaning, in a disaster, oftentimes your equipment's damaged, so you need to replace equipment. You do need to make expenses and pay expenses to vendors to get back into operation. So that might be getting more supplies, buying more inventory. It could be a host of things of that nature, getting some office supplies back in because that got destroyed. But essentially, you're paying for operating expenses. Now, while you're under the PPP loan program, you cannot use it for payroll costs. It's not allowed because you can't double dip in that regard. What else? So it can be used for paying all these other operating expenses, fixed debts that you might have. So that's going to be bank loans that you've had, as well as any mortgage interest or principal payments can fall under this loan program. For the EIDL, there is no forgiveness for it. My understanding is, I believe, but it would have to be, you have to check this with the SBA. I don't believe there's any prepayment penalties via the CARES Act. So that way you can prepay this early. And as I said earlier, there's no fee, no obligation to take one of these loans. You can apply, see if you get approved for the amount of funds that you feel you need to keep your operations going during this particular difficult and uncertain time. And that's the EIDL. It's a program that's been around, supported and provided through the SBA from a disaster, natural disaster perspective.
Mike, a question somebody asked me and they wanted me to ask you was, they really need the PPP in order to make sure that they're making payroll over the next couple months. So should they wait until that's underwritten and funded before they apply for the EIDL loan? Will that in any way create an issue where they've applied for both and that's going to hold things up?
Not that I'm aware of. I think for some, it's going to be based on your circumstances and your level of capital that you need to go through this, uncertain time. If at the end of the time period with the PPP loan, now all of a sudden you are completely out of cash, then I would suggest you probably go ahead and apply for it now, or apply for it certainly well before you use up all those PPP loan funds, because you can apply for both. It is allowed. You just cannot use the proceeds from the EIDL as you are using them for the PPP loan during that covered period. Certainly once that is over, that period is over, and you now have this loan for the EIDL, and you've now used all your funds for the PPP loan, and you're now applying for your forgiveness and whatever. Over here, those other funds can then support your operations at that point going forward. So that would be more of an individual basis in terms of what, for me, from a strategy perspective, is best. Should I apply now and get that done and underwritten and funded before my PPP loan runs out? And you're going really, again, through two different channels. One channel is the bank, that's the PPP loan. The other channel is the SBA directly, and its underwriters determining whether or not you qualify for that EIDL loan.
Mike, somebody else wanted to know, they have 6 different companies and some don't have payroll, but 2 of them do. So can this person apply for each one of those companies? Is it just one Social Security number owner for each application? How does that work?
That's a great question. That if you've got an entity and those two entities are owned by the same person, there are some rules in the SBA that's called, I forgot the name of it right off the top of my head, but it's essentially association with how many employees you've got. So I'll give you an example. If you are a company that's owned by a private equity group that has maybe 25% or more, or 20% or more ownership in your business, then if you've got 100 employees, but the private equity group owns some other companies that have employees, you've got to look to see, do I still fall under that 500 limit related to that owner's other companies, right? And how many employees they have. That's an area that's a little bit squishy, that I don't know a lot about, but that is part of the equation. So in this case, what you might do is you go to your bank, and as the logic, the intent, I think the intent behind this ruling is for the companies, whether you've got two separate companies, and even though it's two separate owners, they want to keep those employees employed, right, in both businesses. So does it come under like one loan? Well, if it's one owner with those two companies, my thinking, this is Mike only, this isn't a fact, you really want to verify this with your bank, is you pull them together. How many employees total? Is it still under 500? Okay, great. Go through the same process in terms of the 940s and the 941s and all the documentation, and then come up with, here's the grand total, company A, company B, total, and then my 2.5 of my payroll costs, and this is my loan amount. And if I'm the owner 100%, or if I'm the 80% owner of both, and there's 20% by one person, 20% by the other, then those 20% owners have to certify on the application. And I would think, again, this is Mike speaking, you could apply for that one loan for those two companies. The difficulty is if they've got two separate tax IDs,
right,
and so on, but common ownership, that's the difficult part. Are you able to apply for both companies independently or together? I think when you talk with your banker, they're going to be better able to tell you, go ahead and apply. We'll underwrite you as one, or no, apply for two separate ones because they're two separate entities. Granted, you own both, but it's really two tax IDs and you get two loans for each one. So I hate to say it, but I'm going to defer to the banker.
Fair enough. And as far as the, so that's for the PPP, as far as the economic injury disaster loan, same advice?
Yeah.
Okay.
Same advice would be for that as well. Correct.
All right. I know we spent a lot of time on the first two because I think that's where people have the most questions. Yeah. But would you mind going over the tax deferral as well as the retention credit? Because I know there's some confusion around those.
There is. So we'll pull up the screen here. We've got two other programs. We've got the delay the employer payroll tax, which is 6.2%. You can defer, and then an employee retention credit program. So I'll go over the deferral because it's fairly straightforward. And then I'll go over the retention credit as well. So the delayed employer payroll tax was written into the act, and it is allowing the employer to go ahead and from this point through the end of this year, fiscal year 2020, you can defer paying the employer portion of the payroll tax, Social Security tax, FICA, and that is 6.2% of your compensation that you're paying from here till the end of the year. You can defer that amount and not pay that. And then what happens is you will pay that back, but it'll be paid back in 2 installments. The first installment must be paid back 50% of it by the end of 2021, December 2021, and the next 50% by the end of December of 2022. So for example, if between now and the end of the year, I decide to take this program and I tell my payroll provider or my in-house payroll to stop the 6.2% tax withholding for the employer piece, then let's say that ends up being $100,000 by the end of the year. So you saved cash flow wise, the company saved having to pay out $100,000. So that's a benefit for the business. And then in 2021, you will have to, as a business, pay back to the IRS, fill out a form. I'm not sure what form that would be, but they will come up with one as the guidance comes along here, to pay $50,000 at the end of December of 2021 and $50,000 at the end of December 2022. No interest on that is what I understand. It's just the balance of those two amounts as 2 separate installments. Initially, you could not do this program and the PPP program. However, they just came out, the IRS just came out this last week, or actually beginning of this week, I think it was, that you could do this employer payroll tax deferral up to a certain point, even though you are using and applying for the Paycheck Protection Program, PPPP. What they said was in the ruling that you can elect to do the delayed employer payroll tax up until the point you get forgiveness of your loan of the PPP. That's what I understand in reading the regs that were sent to me the other day by a tax professional. So up to that point, if you're under this program, you can defer. And then once you get forgiveness, though, you can't defer anymore. You have to stop. Okay. So it could still be a benefit for those who are doing the PPP loan program to also defer the employer tax portion of that, because again, it does save cash flow for businesses. What you've got to remember is if you're using a third-party payroll provider like an ADP or a Paycheck or somebody of that nature, it is not their responsibility to pay those 2 installments and to keep track of that for you. It's going to be up to the employer to do that. So come the end of the year, you'll come up and you'll say, this is the amount that I've deferred, and they can provide that to you. If you stop paying, you can go, okay, how much did I not pay this year in employer tax? And then the business, have to pay those 2 installments in the subsequent 2021 and 22.
Mike, is that all you have to do to elect to take that, is just simply stop paying that tax?
At this point, that's what my understanding is. You would go and you would elect with your payroll provider, say, I am going to stop paying those taxes at this point. There has not been any that I have seen. There's not been any documentation through the CARES Act that says I've got to apply for it. What I would suggest, though, is that those who are certainly using third-party providers, that they go to their representative and say, I want to elect this. Do you know, is there anything I need to fill out so that I can elect this, or can I just simply stop paying? Some people I know do in-house payroll. What I would again suggest is, I'm not a tax professional, so go to your tax professional before you start this and just say, are you aware of any documentation that I need to do in order to stop doing my employer payroll tax deferral? If they say no, then start. But I have not seen in the CARES Act where it said specifically, you've got to go to the IRS and get this form filled out. Now, that doesn't mean that there is not going to be some further information issued now this week by the IRS. I have not seen it, and if it is out there, certainly I will get it to you or find out and make sure that it gets to your audience.
You've
that's what I
been
know
doing a
about
great job deciphering all this information. I sure am glad there are people like you out there, because I can't read those things.
Well, it's yeah, a lot of stuff can come across your desk, and these days there's a lot that is flowing, and you've got to somehow, what can you pick out that you can kind of figure out and make sense with. So that's the delayed employer payroll tax. That's a great option for those who, let's say you've got your 6 months cash reserve or whatever it is for your business, and you don't see at this point the need to do the Paycheck Protection Program or an EIDL, but you do want to save some cash. This is a way to do that without taking any loans if you're adverse to doing that, or you feel you've got enough runway in your own financials to support not having to take one of those loans out. And there are some businesses, frankly, that are not as impacted currently, and so they don't know whether they will be impacted going down the road, or they see it still sort of playing out where business is as usual. So they might delay using this just simply as a way, again, for cash flow purposes temporarily, because they're not sure whether there will be something that comes down the road that does impact them. The last thing that I've got, and I'll bring back up, is the employee retention credit. And I'm not as familiar with this, but the credit essentially is you'll be provided with a refundable payroll tax credit for 50% of the wages of employees during the COVID crisis. And the way I understand that is that's from essentially the middle of March 13th, through the end of the year. So during this time frame, if you're continuing to pay employees as is, you've kept them on payroll, this credit, and again, I'm not 100% positive. Some folks might ask, well, if I'm doing the PPP loan program, I keep people on, and let's say I keep people on after that, can I take this credit for this whole time? That I don't know for a fact. If you're doing the PPP, my understanding is you had to do one or the other. And then after the PPP program is done and you have loan forgiven, then can you do the retention credit after that? Possibly. That I don't know. That would be something that we'd follow up with a tax advisor to make sure, can we take advantage of that? But this is available to employers whose operations were suspended or have significant shutdown orders. So, think about folks you're servicing in the water treatment, hotels, some restaurants. I mean, they were told, shut down, don't operate during this period of time. So they would be certainly eligible for this. Typically it's going to be for employers of fewer or 100, but there is also provisions for those that are employers that have more than 100 employees that were also subject to this shutdown order. The credit is available for the first $10,000 of compensation per employee and benefits paid. So for every employee that you have on staff, that you keep on staff, that you pay both compensation and their benefits, you can get this potential credit of up to $10,000 per employee as a refundable payroll tax credit. And again, as I said, it's good from March 13th of this year, 2020, to the December 31st of 2020. It wasn't the regs. The CARES Act, I should say, didn't give any real detailed specifics behind this, or specifics about how do you apply for this? What does that look like? I think we're going to get more guidance on this as we go along, and your tax professionals will get more guidance. I think the key is knowing that this is here, it's available, and how best should I see taking advantage of it if it's right for me and my organization. Mm-hmm. And that kind of goes with all 4 of these programs. Some folks might have been right now sitting on the sidelines, not sure what to do, which program to go for. I think there's certainly a mad chase into the PPP loan because they said it's going to be first come, first serve. I think that's true, certainly right now. But frankly, I think if it's so oversubscribed and there was a land rush and all the funds run out, my thought, again, Mike's thinking, is Congress might come back and go, look, okay, we've already run through that $349 billion like that. We still have applications that were out there that couldn't be fulfilled. What can we do to help? And they might authorize some additional funds to go with that. My understanding is for the EIDL, there isn't so much of that first come, first serve, because it is based on underwriting and some repayment capability of the applicant. So I would recommend, look through these programs. You can have your financial advisor, your controller, your bookkeeper, or whatnot. You guys can go through and make these calculations to see where do I get the biggest benefit and how immediate do I need it. If I don't have much cash reserves, much capital available, I might need that PPP loan now because I can't wait. The EIDL loan, same idea. I really can't wait very long. I've got some leeway because this is an application. There is an underwriting to it. It's not an immediate thing that will get processed as fast maybe as a PPP loan, but I need it. Or the other areas where it's a little bit less in terms of cash flow, but it still saves some cash flow, is that delayed employer tax or the employee retention credit. And those are the 4 programs in the CARES Act.
Mike, I can't thank you enough for going through all of those. You answered a lot of questions that I had, and I know you've answered questions out there in the audience. So I just want to thank you again for everybody that's listened. That I know you've helped a lot of people, and this took a lot of time. You just didn't come up with this. You did a lot of research. So thank you for doing that, and thank you for sharing that with us.
Well, I appreciate it, and I certainly appreciate all those that are in your audience. Everybody's trying to do their part. We're doing the best we can, navigating our way through this unprecedented time that we've never been through before. And I applaud all of those small businesses trying their best to keep everybody above water and employed and afloat. And certainly even commend those like yourself and others who are dealing with really hard-hit industries that are trying to see, what's this look like at the end of the day, at the end of the game, because this will end. We'll get there. It's just a matter of what does it look like towards the end. And for any of those of your audience that is also servicing the healthcare market, I applaud you, and I really appreciate all that they're doing. They're the first responders. They're the folks that are, that's one of the reasons that is just fascinating and amazing to me, that we as a country, we as a globe have been able to kind of essentially put things on hold to help those who need to be helped in order to get through this crisis. And it's those healthcare workers that I really want to say thank you and applaud them for it, and your audience who also are doing their part to make all this happen. So thank you.
Yeah. And I know they all appreciate that. Well, Mike, thanks again for coming on, and I'm sure I'll talk to you soon. So you take care and stay safe.
You do. Take care, stay safe. Have a great day.